Now, notice most turnover ratios have sales in the numerator. Cost of goods sold is in the numerator of that inventory turnover ratio. Does it make any difference that we use cost of goods sold in the numerator instead of sales? Well, certainly the ratio value is going to be different. So how do we defend the use of cost of goods sold in the numerator for inventory turnover instead of sales dollars? Well, inventory turnover is supposed to be measuring the actual flow of goods. And if we use sales dollars in the numerator for inventory turnover, that would overstate the actual flow of the goods through the inventory account, which is what we're really trying to measure. How often does the typical item go into inventory and come out of inventory as cost of goods sold? Certainly, marking up beyond the cost of goods sold and selling something at a markup, if we use sales dollars in that numerator, we would be overstating the actual physical flow of goods. So certainly using cost of goods sold in the numerator to calculate inventory turnover will produce a smaller number than would putting sales in that numerator, but using cost of goods sold is going to more accurately reflect the actual physical flow of goods through the inventory account, which is what we're trying to measure. The fourth category is profitability measures. The profitability ratios measure how efficiently a company uses assets and how efficiently it manages its operations. So we're talking about expense control and trying to generate net income. The profit margin and then return on assets and return on equity are the key ratios in measuring profitability. Remember, in Chapter 1, our goal as a financial manager is to maximize shareholder wealth or maximize stock price. Here in Chapter 3, we're looking at different ratios or different book value measures of things instead of market value based measures for the most part. We're getting our information from the firm's financial statements, not from some market driven factor like share price or something like that. So when we measure profit margin or return on assets or return on equity, keep in mind these are book measures, not actual market value based measures of return. So we're trying to look at a firm's financial statements to assess how well it's doing instead of looking at market value based measures such as stock price. So our first profitability measure is the profit margin here. Net income is a percentage of sales. How much of each sales dollar is left after all the expenses are paid and ends up in net income, or the so-called bottom line. The return measures here use net income as our dollar return, but then we divide that by total assets or total equity in the denominator, and that gives us a percentage return on our total assets or total equity. So net income as a percentage of total assets is a percentage return that we earned on our assets that were employed, percentage-wise measured as net income being that return. Return on equity is net income as a percentage of the total equity that the shareholders have invested in the firm. This total equity in the denominator there would include all investments made by the shareholders, whether they explicitly wrote a check for that investment or not. In other words, we are talking about the common stock and additional paid-in capital that the balance sheet would show when the shareholders paid for stock that was issued to them. So their stock investment par value shows up in common stock on the balance sheet. Anything beyond that is called additional paid-in capital. However, this denominator would also include retained earnings, earnings that have been retained inside the firm, because what is not retained out of net income had to be paid out in the form of dividends to the shareholders. If it is not paid to them in the form of dividends but is retained inside the firm, they expect the firm to invest those earnings that have been retained. There's an opportunity cost there. If those earnings had not been retained, by definition, they had to have been paid out to the shareholders as dividends. What is not paid out to the shareholders as dividends out of the net income is retained inside the firm and shows up on the balance sheet, making the retained earnings balance larger. So the opportunity cost is that earnings that were not paid out to the shareholders as dividends can't be invested by the shareholders because it's retained inside the firm. So those shareholders expect the firm to invest the earnings that have been retained inside the firm to produce additional return for the shareholders on down the road. So this total equity in the denominator would include retained earnings as well as the two components when stock was issued to the shareholders, common stock and additional paid-in capital. Shareholders demand a return on all three of those components, including the retained earnings. Now, here's this note about return on equity, and it's a measure of net income as a percentage of the shareholders' investment. So this is a return only on the investment the shareholders made, not the total assets of the firm, but only on the investment the shareholders have made. So this is a measure of their claim on the net income of the firm. But this, by measuring net income, is only looking at their return after all the obligations of the firm have been met. And that would include any preferred dividends that the firm has to pay. So the idea that we're trying to measure the return to the common stockholders reminds us that any preferred dividends that the firm is expected to pay need to come off before we measure the return on equity. So while we may use net income in that numerator, if there are preferred dividends, typically we want to subtract those off and use what's called net income available to common shareholders. So in that numerator for return on equity, if the firm has preferred stock, the preferred dividends come off of the net income, and we use what's called net income available to common shareholders in the numerator. And it looks like this: the net income minus the preferred dividends. And again, the common equity there would be common stock plus additional paid-in capital plus retained earnings. Let's use the financial information for S&S Air to look at some of these profitability ratios. From the income statement, we will need the sales volume, $36,599,300, and we'll need the net income figure, $1,845,242 for S&S Air. We can use that to then calculate the profit margin for S&S. Take that net income number and divide by the sales, and we'll see that for each dollar in sales, S&S generated 5 cents in net income. The net income was 5.04% of S&S's sales volume. The industry median was 6.98%, so S&S is certainly below average in that respect compared to the industry median. It's not doing as good of a job generating net income out of each sales dollar that it generates. That's consistent with something we saw earlier when the times interest earned ratio was a little low, but the cash coverage ratio was high. We thought maybe they had a lot of depreciation expense. That would be consistent with this profit margin being low. They may have a lot of depreciation expense, just as one possible explanation. You don't need to go into it that deeply a lot of times, just for our purposes in the course, but that's the type of question that a financial analyst would start to ask, is what might make their profit margin low. We saw something previously looking at other ratios that made us believe maybe their depreciation was a little bit high. The second profitability ratio we look at is return on assets. As we already saw, we'll need that net income figure from S&S's income statement. And then we'll need the total asset figure from S&S's balance sheet, $17,379,480. So we can compute S&S's return on assets by taking the net income and dividing by the total assets. And we see that S&S generated 10.62 cents in net income for each dollar invested, which is just about the same as the industry median. So S&S is doing an average job generating net income as a percentage of the total assets that it has employed. Now we'll calculate that third and final profitability ratio, which is return on equity. We'll take net income and divide by common equity. We've already used the net income figure. We need the common equity amount from the balance sheet. It's the sum of the common stock, $322,500, and the retained earnings, $9,233,930. The total equity is already subtotaled for us, $9,556,430 is the total equity. So we will use that total equity number in the denominator, divide the net income by common equity, and we'll see that S&S is earning a return on equity of 19.31%. The industry median for return on equity is 16.54%. So obviously S&S is doing a better job generating net income as a percentage of the equity that the shareholders have invested when compared to the median firm in the industry. So S&S is doing a good job generating net income for its common shareholders. Had this firm paid any preferred dividends, remember we would use that net income available to common shareholders. Since there were no preferred dividends, we use net income because there were no preferred dividends that went to preferred shareholders. So all this net income belongs to the common shareholders. So S&S is doing a good job generating net income and providing a return for its common shareholders. Now again, that's on a book value basis. We don't know what's happened to the stock price, but as far as the financial statements indicate, S&S is doing a good job generating net income for its common shareholders. For the market value numbers here, price earnings ratio or PE ratio is one that's commonly used, price per share divided by earnings per share, and the market to book ratio, the market value per share divided by the book value of the equity shown on the firm's financial statements. So those ratios would give us some idea if the marketplace is putting a lot of value on the earnings that a firm produces. If a firm sells at a relatively high price earnings ratio, say 30 times earnings or something like that, you can imagine it would take 30 years for it to generate enough earnings to justify the purchase price. And so the market is putting sort of a premium value on that versus a firm that only sells at 5 or 7 times earnings. It's not being valued nearly as highly. The market value compared to the book value of the firm's equity is another way to say, well, we can see what investment the shareholders have put into the firm on a book value basis, their common stock, paid-in capital, and retained earnings. And then if the market is putting a premium on that, that shows good prospects for the future. So those market value ratios, when compared to book or something like that, would give us an idea what the market thinks the future holds for the firm. Now, DuPont analysis is another way to look at that return on equity ratio. Arguably, ROE is a pretty valuable ratio as far as the book value ratios go, because this is telling us what kind of return, granted it's book return, net income, not market return as far as stock price appreciation or dividends or something like that. But as far as the book value ratios go, ROE is a key ratio because we're looking at income expressed as a percentage of the investment that the stockholders have made. Our goal is to maximize stockholder wealth, so this tells us the book value return that the stockholders have received as far as net income as a percentage of their equity investment. This DuPont analysis takes ROE, and for our purposes, we'll break it down or decompose ROE only into 3 components. Figure 3.1 of the textbook shows the expanded or extended DuPont chart for DuPont itself, where return on equity is broken down first into 2 ratios, and those are 2 we'll see. And that's further broken down, and ROA is broken down into profit margin, total asset turnover, which would be multiplied by the equity multiplier. That is as deep as we will take it, but the figure 3.1 shows you could break these different components down into much more detail to try to look and see what is driving your profit margin or your total asset turnover or this equity multiplier. So we'll leave it just at 3 components for ROE. The base definition of return on equity is net income divided by common equity. The 3-term decomposition for ROE can be obtained by dividing and multiplying by sales and dividing and multiplying by total assets. If we do that, then that brings us to our definition of profit margin, net income as a percentage of sales, times total asset turnover, which is sales divided by total assets, times this term that we've not seen before, the equity multiplier, which is total assets divided by equity. At any time, the product of these 3 terms would take us right back to our base definition of return on equity if we just canceled sales and total assets right out of that 3-term decomposition. Total assets could be canceled out, sales could be canceled out. We would have net income divided by equity, which is our definition of ROE. Well, if we just make that first cancellation of sales, we see the product of profit margin and total asset turnover would be net income over total assets. That's our definition of return on assets. If that ROA is then multiplied by this new ratio here, the equity multiplier, total assets over equity, cancel the total assets, that would produce ROE, net income over equity. So make the first cancellation here, and we get net income over total assets, which is ROA. If that's multiplied by this equity multiplier here, then we would get our return on equity definition. That allows us to see what this equity multiplier does. We have some return on assets, which is simply profit margin times total asset turnover. When that's multiplied by this equity multiplier, if that equity multiplier is greater than 1, then the ROA would be multiplied by something greater than 1. That would produce an ROE that is even larger than the firm's ROA. So in other words, the ROA could be multiplied into a larger ROE whenever the equity multiplier is greater than 1. Now, let's think about what would cause the equity multiplier to be greater than 1. Certainly it's greater than 1 when the total assets exceed the equity of the firm. How can the total assets exceed the equity of the firm? Well, a firm's assets will exceed its equity whenever it has debt. If we think about the balance sheet equation, such as good old assets equals liability plus owner's equity, or assets equals debt plus equity, simply enough, then let's just throw some numbers in there. If a firm has $10 million in assets and we see that it has $6 million in equity, then for the balance sheet equation to balance, then the firm must have $4 million in debt. So we know that whenever the assets are greater than the equity, then the debt would have to explain the difference. So when the assets are greater than the equity, then the debt is greater than 0. The firm has some debt whenever the firm's assets exceed the equity. Another way to think about that is if the assets exceed the equity that the shareholders put into the firm, then creditors, debt holders, have some investment that's been made into the firm as well. Example 3.5 will illustrate more about the relationship of return on assets to return on equity, and then we'll talk about the equity multiplier just a little bit more. In example 3.5, the PDQ Corporation has a profit margin of 7%. So in other words, 7% of each sales dollar ends up in net income. A total asset turnover of 2 times, which means its sales are twice its total assets, and an equity multiplier of 1.5 times, which means the firm's assets are 1.5 times the equity investment that the shareholders have made inside the firm. So we're supposed to calculate the return on assets and the return on equity for the firm, and we'll use the DuPont equation to do that. First step is to calculate the return on assets. As we saw, ROA is the product of the profit margin times the total asset turnover. For PDQ, 7 cents out of each sales dollar ends up in net income, and its sales are 2 times its total assets. So that firm is producing 14 cents in net income for each $1 of assets it employs. So its return on assets is 14%. The profit margin of 7% times the fact that it turns its assets over twice per year produces a return on its assets of 14%. For the return on equity, we'll take that equity multiplier. It's the third term in the DuPont decomposition, so we can multiply all 3, profit margin, total asset turnover, and equity multiplier together to get the ROE, or we can simply take that ROA and multiply it by that equity multiplier and see that the firm is producing a 21% return on the equity that the shareholders have invested inside the firm. So since the return on assets is profit margin times total asset turnover of 14%, and that then gets multiplied by the equity multiplier of 1.5, the ROE of 21% is the product of profit margin, total asset turnover, and the equity multiplier, all 3. So you can do the 3-term DuPont, or you can just do ROA times the firm's equity multiplier to get the ROE. Now, in this case, DuPont should be considered a pretty good illustration of what debt does for the firm. The firm's assets were producing a 14% return, but the shareholders did not have to put up the full amount to purchase and put in place the assets that the firm used. Because the equity multiplier, which is assets over equity, was 1.5 times. So that equity multiplier being greater than 1 is what multiplied the ROA into an even larger ROE. So DuPont illustrates the fact that debt, leverage, or the use of debt will boost our ROE, return on equity, above our return on assets. When you have a healthy return on assets, it's nice that the firm has some debt because the shareholders did not put up the full investment in assets. The firm borrowed, so the firm's shareholders actually get a larger return on their equity investment than what the assets produced. Now again, this equity multiplier is assets over equity. How is that a measure of leverage or debt? Debt's not even in the ratio. So the equity multiplier measures the one thing that's not there out of the balance sheet equation. The balance sheet equation is assets equals debt plus equity. Debt is not here, but that's what that equity multiplier actually measures. Because if your assets exceed your equity, that makes that equity multiplier greater than 1. If your assets exceed your equity, the firm has to have some debt because assets equals debt plus equity. And while our goal might be to maximize shareholder wealth or stock price, in a book value sense, ROE is something we'd like to be higher rather than lower. So if we want to improve ROE, there's a few things we might try to do. One, typically more sales is going to help us produce more net income to produce a higher return for our shareholders. So if we can increase sales without our costs or expenses going up disproportionately, then that would probably produce more net income and thus produce a higher return on equity. But that's not always a given, because it has to be without this disproportionate increase in costs and expenses. If I wanted to increase sales by 20%, and I found out that to be able to do that, I have to increase my commission structure by 50%, so my selling expenses would go up by 50%, and that would help me generate some more net income. I might not find that being really beneficial to do that, because the expenses might outweigh the additional increase in sales. Now let's think about how we might improve our return on equity. While this is not a market value measure like stock price, in a book value sense, ROE is probably the ratio we would like to improve more than any other. So let's assume for now we'll focus on that, ways to improve ROE. The first way is if I can produce more sales. More sales is better than less sales, everything else equal. So I could have a goal of trying to increase my sales, but I would have to be able to do that without disproportionately increasing my costs and expenses. I'm trying to increase sales so I can generate more net income to boost my ROE. If I try to increase sales by 20%, but that requires me to increase my commissions paid to my sales force by 50%, then that might actually lower net income. It might increase the sales by 20%, but it increases the costs even more than it could actually drive net income down and lower my ROE. So I've got to be able to find a way to increase sales without expenses going up even more rapidly. The second is to control expenses, to try to reduce the cost of goods sold or my operating expenses, and that would make net income a greater percentage of sales. In other words, try to increase my profit margin. That's the first term in DuPont. That would drive the ROE up, everything else equal. The third way to benefit and improve ROE would be to try to turn our assets over more often. Again, try to increase sales or reduce the asset investment that is necessary to produce the same sales volume. If I can produce the same sales volume on a lower investment in assets, I could liquidate those excess assets and use it to pay down debt or do something that'd be more efficient if I have more assets than I really need. And the fourth way is to lever the firm. Increase the use of debt, but don't do it too far. We don't want to drive the firm into bankruptcy, certainly. That would not be good for the shareholders. But leverage, we saw, can be a good thing. It can lever or multiply that return on assets into a higher return on equity. So if the firm can take on some more debt, and that will multiply that return on assets by an even larger equity multiplier, then ROE would go up. But too much debt could be a bad thing. Certainly, if the firm's ROA is not healthy, if it's experiencing losses, we definitely don't want to have debt and multiply that loss, the negative ROA, by an even larger equity multiplier, because that would make our return on equity even more negative. So return on assets has to be healthy for a firm to benefit from additional debt. Now, we've talked about ratios throughout the chapter, but we haven't really talked about the considerations that we need to have as we're employing the ratios. So we can calculate the ratios and compare them to an industry median and sort of think about how well the firm might be performing, but we need to keep a few things in mind. One, so far we've been using an industry median category for S&S Air that was given to us. But an industry is not always the easiest thing or necessarily the perfect thing against which to compare a firm's performance. If we think about discount retailing, typically Walmart might come to mind, or Target, or perhaps Kmart. But if we look at a particular SIC code for discount retailers, some department stores such as JCPenney may end up in that same industry category, and we may not see Walmart being comparable to Penny's, where it might be fairly directly comparable with Kmart, for example. So the industry or the peer could be pretty different or difficult. And then what about a conglomerate such as General Electric, who makes home appliances and light bulbs and nuclear reactors and aircraft engine, and it has GE Capital, which is a very large financial subsidiary of the parent company. And so GE certainly does a lot of things. And so to compare GE overall to an industry average would be quite difficult. So we probably need to segment it and compare its segments to their peers, which might be individual firms in particular industries. And so we would just be looking at segments of GE against industry averages for their related industry. Another thing to keep in mind is accounting procedures might differ across firms, making the ratios a little difficult to compare. Inventory costing and things like that could make it difficult. Another thing is an optimal value for a ratio is difficult sometimes to identify. For example, a current ratio. If a firm has a current ratio less than 1, I would have a hard time thinking that it has sufficient liquidity. If a current ratio is less than 1, the firm is probably not very liquid. Would a firm with a current ratio of 1.5 or 2 be more liquid than a firm with a current ratio below 1? Well, certainly so. Does that mean a current ratio of 1.5 or 2 is better than a current ratio of 0.7? Well, probably so in most instances. Does that mean a current ratio of 3 is better than 2? Is 4 better than 2? Well, perhaps. Is 10 better than 2 for a current ratio? At some point, we could have too much liquidity. We want to have enough liquidity to be able to transact, have enough inventory to satisfy our customers' needs, to have some receivables because we extend them credit terms. But if we have more than enough current assets, that's inefficient. So a current ratio of 10 or 12 times is probably too high. We have too much of an investment in current assets, and we need to reduce that investment and invest in assets that produce a return instead of current assets that just sit idle. Fourth here is that the industry average or the median may not be optimal. If we compare ourselves to the industry median or the average and we say, well, we're a little bit higher in this one particular ratio, and I think that's good because the industry is certainly a very, very, very good number. Well, it may not be. The entire industry may not be performing well. Furthermore, do you aspire to be average? Do you as an individual want to get an average score on a test or something like that? If you're the financial manager and you say that you aspire for the firm to be average, you're probably not going to be with that firm very long. You probably want to aspire to show improvement and move above average and be the best, and you have different time frames in which to accomplish that. But to aspire to be average is probably not going to cut it in most instances. Another thing is seasonality can distort ratios. Some of the ratios use one item from the income statement and another item from the balance sheet. Well, the income statement covers a whole year of time, and the balance sheet is as of a particular date. So if we think about inventory turnover, it would vary quite a bit based upon the balance sheet date that we pick. With cost of goods sold in the numerator, that's for a year's time. Inventory in the denominator is as of the balance sheet date. So think about a seasonal firm like Toys R Us. If we calculated its inventory turnover by using its inventory in the middle of November in the denominator, that's going to be probably the highest point in the year for Toys R Us's inventory, and we use that as the denominator. Its inventory turnover won't look very good. Instead, if we were to use its inventory in February or something like that, it's probably a lot smaller. The denominator inventory would be a lot smaller using a February balance sheet date. The inventory turnover would look a lot higher. So some analysts would suggest using an average of beginning and ending inventory, but it might be that if we see the firm has some amount of inventory in January, February, March, April, May that's fairly stable, and then it has a very large inventory balance only in October, November, December, then perhaps we need to try to use some averaging of those different months. If 9 months it has an inventory amount that's small, and 3 months it has an inventory balance that's very large, then the typical inventory is going to be on the smaller end of things. We need to try to figure out what inventory balance to use in that denominator that fairly reflects the whole year. That concludes our presentation of Chapter 3, so you'll want to review those learning outcome statements, fill those in, think about your answers, and compare them to mine in the slides that are posted to Blackboard. Here are the concept review questions for Chapter 3. As always, I encourage you to pause the lecture at this point, read through these, and offer your own answers, and then continue the lecture and see if your answers are similar to mine. The purpose of ratios is to express accounting numbers in a relative sense, which can make financial statements much easier to understand and interpret. It takes complex financial statements and expresses them in ratios and gives comparisons to make things easier to understand. Two useful benchmarks are to compare a company's ratios to itself across time, so we can see what trends are present, and to compare a firm to the peer firms, or often an industry average, to see how the company compares to firms like it. The DuPont equation uses 3 terms to decompose return on common equity into a few more manageable components. The DuPont equation is ultimately net income divided by equity, which is the definition of ROE, but if we divide by sales and multiply by sales, and divide by total assets and multiply by total assets, we haven't changed anything, because those would always cancel right back out, and we would be left with 3 terms, the product of those 3 terms being return on equity. Those terms are profit margin, total asset turnover, and the equity multiplier. The equity multiplier here is the measure of leverage or the use of debt. It shows us how we could take the return on assets, the product of these first 2, and multiply or lever that into a higher return on equity by using debt. So when our ROA is positive and we have debt, it would be multiplied into a larger ROE. The quick ratio excludes inventory, so it is useful when a firm is not expected to be able to use inventory to satisfy its short-term obligations. If the inventory is not liquid and it's not going to help us meet our bills, then we don't want it falsely inflating our liquidity. So don't use the current ratio, use the quick ratio when the inventory is not liquid or not useful in meeting obligations. The debt ratio might be most useful to a lender considering to make a long-term loan, because it looks at the percentage of the assets already claimed by other lenders, which is sort of a collateral approach. Indicates the likelihood of the debt being satisfied if the firm is liquidated, which again is a longer term focus. Collateral value, or thinking about liquidation to meet obligations, is a long-term focus. The times interest earned ratio might be useful for a short-term lender, since it's more reflective of the firm's liquidity position, how it's going to cover interest expense out of operating income period after period or on a shorter term basis. If a firm wishes to increase its return on equity, it could increase sales without increasing costs disproportionately. If it has to pay a lot more in advertising or larger commissions or something like that to increase sales, then it may not be productive to try to do that. But if it can increase sales without the costs going up faster, then that might benefit the return on equity. If it could reduce the cost of goods sold or reduce expenses without having to give up much sales, or turn its assets over more often, or lever the firm and use debt, then all those would tend to boost the return on equity. As long as the firm has a positive ROA, then DuPont showed us the debt would lever that into a higher ROE. So turning the assets over more often, increasing sales without costs going up, reducing expenses or cost of goods sold, all those will help the net income and help the ROE, as will debt when we multiply the return on assets into a larger ROE. Limitations of ratio analyses include that determining the industry or peer firms can be difficult, especially for conglomerates that don't fit into one industry or firms that don't seem to be really like any other firm. Accounting procedures differ across firms, so those industry averages are only approximations. So it's hard to compare a firm to an industry average if its accounting treatment of things might differ quite a bit. Determining an optimal value for a ratio is difficult, such as should the current ratio be 2 or 5 or is 10 better? And well, it really depends on the nature of the firm and how much liquidity is really needed. So it's difficult to determine the optimal value for a ratio. And the industry average may not be optimal. So if we say, well, we're slightly above the industry average and we think we're doing well in a particular category, and then we find out the industry is really doing poorly and we're only doing slightly better than that, then that's not giving us good information. Seasonality can be a problem, especially if a firm's ratios come partly from the income statement and partly from the balance sheet. The income statement item might cover the entire year, but the balance sheet would be as of the balance sheet date. So if we pick a particular date, such as calculating inventory turnover, we use a date when the inventory is really, really high for the firm, then the inventory turnover might look low, as opposed to using a date when their inventory is relatively low, then the inventory turnover might look high. So if there's seasonality, we've got to be aware of that. Some would advocate using an average inventory amount to calculate inventory turnover or something like that. In Chapter 3, we examine different categories of ratios, how to calculate those, and how to analyze them to get a better idea why a firm is performing well or not performing well and how it might do better. We took return on equity and decomposed it into those 3 components: profit margin, total asset turnover, and the equity multiplier, which actually is a measure of leverage, comparing the firm's assets to its equity to see how much debt the firm is using. We also explained that ratios have to be used rather carefully. When they're interpreted or calculated, there are certain issues that we need to be aware of. So we explained that the limitations or the caveats when using ratios. Now that you've completed the Chapter 3 lecture, you should complete the supplemental homework practice problems at the end of the chapter in your course notes. The solutions are found on iTunes U, where I use the document camera to work the solutions. And we've posted a PowerPoint file to Blackboard that gives the answers. So work those first before you check your answers. Then attempt the blank Connect assignment that we've posted to Blackboard before you actually do the online Connect assignment. You'll want to check the syllabus for the chapters covered and the due date for each Connect assignment, because some Connect assignments cover more than one chapter. Come to class and we'll go over the solutions to the blank Connect assignment. And if you want us to look at your actual Connect assignment, you'll need to print it off or bring your laptop so that we may look at it with you during class. Begin preparing for the exam early. Compile your exam formula sheet chapter by chapter as you go. Don't wait until near the exam date to do it all, but do it chapter by chapter. And then remember, we post the Connect assignments after the due date so that you can rework them for additional practice an unlimited number of times after they are due. The problems generate new numbers every time you work them, so you may do an unlimited number of attempts after the Connect assignment is due for additional practice.